Welcome to our comprehensive guide on downside risk and upside risk in investments. Today, we'll dive deep into these crucial financial metrics, explore their significance, and use data and examples to enhance your understanding. Risk is an inherent part of investing. Understanding the types of risk, particularly downside and upside risk, helps investors make informed choices. Downside risk pertains to the potential loss in an investment, while upside risk refers to the potential gain. Let's start with downside risk. Simply put, downside risk is the likelihood of a security declining in value. Investors use it to gauge potential losses. Consider a stock currently valued at $100. If market analysts predict with substantial evidence that the value could drop to $80 in a severe downturn, the downside risk is 20%. A key metric used to measure downside risk is the value at risk VAR. VAR quantifies the maximum loss an investment might experience over a specific period, given normal market conditions. If you have a portfolio with a one-day 5% VAR of $5,000, it means there's a 5% chance your portfolio will lose more than $5,000 in a day. Downside risk and VAR are crucial for risk-averse investors who prioritize the protection of their capital over maximizing returns. For example, retirees depending on their pensions will focus more on downside risk. Now, let's shift gears to upside risk. Upside risk represents the potential for investment gain. Investors need to understand upside risk to identify profitable opportunities. Imagine the same stock valued at $100. Market analysts predict it might rise to $150 if certain conditions are met. The upside risk here is 50%. Metrics like the Sharpe ratio can help evaluate upside risk. The Sharpe ratio measures the performance of an investment compared to a risk-free asset, after adjusting for its risk. For instance, if the expected return on an investment is 10%, the risk-free rate is 2%, and the standard deviation is 5%, the Sharpe ratio is calculated as follows. Understanding upside risk is vital for aggressive investors aiming for high returns, such as young professionals willing to take on more risk for potentially higher rewards. So how do we balance downside and upside risk? It boils down to an investor's risk tolerance, investment horizon, and financial goals. A diversified portfolio often helps achieve this balance. In summary, downside risk measures potential losses, critical for conservative investors. Upside risk measures potential gains, essential for those seeking higher returns. Balancing both is key to a sound investment strategy. Thank you for watching. We hope this video has clarified the concepts of downside and upside risk. If you have any questions, feel free to leave a comment below. Don't forget to like, share, and subscribe for more financial insights.